Hello traders, Gary Wagner here just before 4 o'clock in Honolulu, 10 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. 6th day of October, 2017, and this is the Daily Report for Gold and Silver, our weekend review, and an evening edition at that. Gold staged a dramatic recovery today after trading to a new low. The low that it hit was $12.62 intraday and closed effectively higher at $12.78.90, up about $5.70. As you will see in today's report, the numbers we were looking for gold to go to were precisely around the $12.65 level, so our target has been hit. Silver also trading higher on the day, up about 21 cents at $16.85, and that is all in light of a moderately lower dollar index at 93.64, which put it down 16 points on the day. Interesting action in gold trading today, with gold trading to a new low on the day and then staging a pretty nice recovery. Considering that over the last 3 trading days, we have seen a series of lower highs as well as a series of lower lows on all 3 days, you might ask, where are we looking at potential support for the market, and why do I currently believe that this area could provide a substantial opportunity next week if in fact we see follow-through buying come into the market early next week. We are currently looking at a single day candlestick chart, and on this candlestick chart we do have a couple of key Fibonacci retracement areas, specifically the area and the target that we have been looking at for the better part of the week has been a belief that we would see gold trade as low as $12.65, and that was based upon a 61% retracement of the entire scope of this rally. And traders, we certainly hit that target today as the market did track lower, trading to that low of $12.62, right at our mark, and then closing substantially higher on the day at $12.78.90. And traders, while it hit the low today and did recover, we could see over the last few days that we were absolutely staging a pretty strong recovery. And to illustrate that point, I have converted our daily chart into a 3-day candlestick chart. This last candle representing the last 3 days of the trading week. We can see that that has formed a doji candle, almost a hammer-like candle, and it also occurred at precisely the low predicted from a 61.8% retracement of the entire rally. And traders, that causes us to also reevaluate the Elliott wave count that we have been looking at and to revise it to reflect current market scenarios. Now, our former Elliott wave count simply looked at our wave 1 as moving from 12 to 1280, 23% retracement, wave 2, and then wave 3 going up to our record high this year of 1363. However, because of the depth of this current correction, we cannot label this rally in a series of 2 legs because it breaks one of the golden rules of Elliott wave. And that golden rule states that wave 4 cannot overlap any of the price territory of wave 1. And since we looked at the territory of wave 1 as going from 1200 to 1283, once the market traded below the 78% retracement area at 1279, or even the 50% retracement of the entire rally at 1284, we then would violate that particular wave count because we have effectively seen price point trade within the territory of wave 1. For that reason, we have to revise our current Elliott wave count. And in essence, our revised wave count is simplified and looks something like this. This rally was composed of 5 legs, but resulted in a termination or a conclusion of a wave 1. This correction that followed, if complete at this point, would be the termination of our wave 2, and then we are now moving into a wave 3 scenario. Traders, realize that Elliott wave modeling and forecasting is as much of an art as it is a science, and if we have a current model that is invalidated by data coming in, as we saw in this case, we have to be able to revise the model to account for the actual data that we're being presented with. Now, given this new model, if we are correct and if we've just entered a third wave, well, that draws some really exciting potential conclusions. First of all, we know that one of the golden rules simply states that wave 3 cannot be the shortest of any of the impulse waves. We now have a wave 1 in place in which we have a size of the rally, and what I've done is simply created a scalable trend line that now begins from the lows achieved this week, and assuming that we are going into a wave 3 scenario, even at a 1-to-1, meaning if wave 1 and wave 3 are equal, my new target for this rally has now gone to 1420 based upon equal moves, and next week we will look at the potential for a 1.23 or a 1.38 or even a 1.618 extension, and look to see where the model takes gold pricing. Traders, maintain our current neutral stance, but as I've said all throughout the show, if we have follow-through movement on Monday, we will enter gold from the long side. Traders, as we talked about all week and through today's show, we have been looking for an effective area in which we believe the conclusion will unfold for the most recent correction in gold. The numbers that we were looking at were Fibonacci base 1265, which is a 61.8% retracement of the entire rally from 1200 to 1363. Based on that information and based on the recovery today, follow through buying on Sunday here in Hawaii, of course Monday in Australia, Hong Kong, as it moves around the world into New York, would signal a strong potential for a bottom, and we will act accordingly. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for another daily update and review. Bye-bye.